Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. Very recently I did an article on Microsoft, and in the comments section of that article, plus comment sections of other articles I've written and other comments I've seen, people often talk about how valuation really doesn't matter when you're looking at, for example, the Fang stocks, which were made popular by Jim Cramer, and which of course are Facebook, Amazon, Netflix, and Google, or now also known as Alphabet. And so what I'm going to do is I'm going to take a look with this Analyze Out Loud video at the Fang stocks. I'm going to do them in alphabetical order, so we'll start with Amazon. But there's a couple of things here that I think people really need to understand as I tried to articulate in the written portion. You know, certain things like PE ratios. For example, using this portfolio review here, if you look at Netflix, you know, the blended PE ratio on that company is 159.7. The blended PE ratio for Amazon is 153.2. Google has a more rational PE of 31, and Facebook currently has a blended PE of 26.6. So, you know, these valuation references don't really make sense for these very, very high growth stocks like all of these companies are. Now, if you look at price to cash flow, I want you to notice Netflix has no meaningful figure here because, believe it or not, Netflix doesn't generate any cash flows, and I'll talk about that when I get talking more specifically about the company. Amazon is priced at 33.9 times cash flow, which is actually pretty reasonable for them, as well as Google is priced at 19.9 and Facebook. The point is, there are different ways to value stocks, and when you're dealing with these high growth stocks, some of the traditional fundamentals like PE ratios, for example, don't really work as well as they would if you were looking at a more, typical stock like General Mills or McDonald's or Colgate-Palmolive or PepsiCo or Coca-Cola, etc. These are a different class of animal, and I'm going to try to illustrate that as I go through. Now, I'm going to do them in alphabetical order, so let's go ahead and start with Amazon. And let's take a look at Amazon, which is obviously a terrific growth stock historically. And I'm going to start out here looking at earnings, Amazon's earnings. Now I'm going to take some things off of the graph here. If I look at Amazon's profits over the last several years, the picture's not really so good. Now, estimates are really attractive. That's what that big, high surge looks like here. But if I look through 2017, I'm not even calculating earnings growth. We had negative earnings in 2014 and 2012. And I'll shorten the time frame here a little so you can see these numbers better. We have a lot of years where you have negative earnings growth, and you have a couple of years where you actually have negative earnings. So, the company's earnings have not been that great. But Jeff Bezos often talked about the fact, in fact, he did when he first came public with his company, that he wasn't really interested in generating profits. He wasn't going to try. What he was going to do is focus on cash flow. So here we're looking at Amazon. I'm looking only historical numbers here now. Their operating cash flow growth has been 29.1%, and that's what the PE of this orange line, or the price to operating cash flow of this orange line, is 29.1. So anywhere the black stock price line touches that orange line, it's trading at a price to cash flow of 29.1. The blue line is a price to cash flow of 24.6. And this kind of gives you a very, what I'll call, classic range of valuation for Amazon going back to 2006 through current. Now, what's interesting is forecast-wise, analysts are expecting tremendous growth in operating cash flow for Amazon. But what I really want you to notice by looking at this graph, the correlation of Amazon's stock price to their operating cash flow has been extraordinary. The company's price clearly went where their operating cash flow has, and at a very high multiple, at a multiple of somewhere in the 30 times cash flow area. Now, if I look at EBITDA, earnings before interest, taxes, depreciation, and amortization, I also see a very high correlation of Amazon's stock price to its EBITDA. And again, I see forecasts for very high EBITDA growth going forward. So if this were really to be true, the rates of return on investing in Amazon here could still be extraordinary if they end up manifesting the EBITDA that we're suggesting. But if I go back to operating earnings, which is not really what their ballywalk is now, they're not really interested in making earnings, and I look at earnings projections, then you're looking at a very highly overvalued stock. But I think it's important to recognize when you're looking at this that the market has been valuing this stock based on cash flows and EBITDA a lot more predictably than they've been basing it on earnings. So price to earnings don't really make a lot of sense. But let's go into fund graphs here because there's something I want you to look at real quickly here. I'm looking at fund graphs here, what we call financial underlying numbers, and I'm looking at revenue. This is revenue per share. Amazon has gone from 57 cents of revenue per share in 1997 to $370.55 of revenue per share in 2017. That's a 38% growth rate in revenue. So they may not be bringing a lot to the bottom line, but this is clearly a growth stock. And I think that's something you really have to look at here. The company generates prodigious amounts of cash flow and certainly is growing their revenue and their top line dramatically, even though they're not bringing a lot to the bottom line. The next FANG stock I'm going to look at is Facebook. Now, when you look at Facebook's price to earnings relationship here, you can see that earnings have gone up dramatically, averaging over 31% growth. I'm using operating earnings here. And the stock price has tracked those earnings. Now, there were times when the PEs got up into the 50 and 60 range. Technically, here's a 66.9 PE. That's really twice the company's growth rate. That would be a PEG ratio of 2, who utilize things like PEG ratios. But even though the PE was almost 67 times earnings, you still would have made 24% a year buying Facebook because of the power of compounding, because earnings growth has been extraordinary here. Now, if we look at Facebook from an operating cash flow point of view, which kind of part of this, the idea of looking at cash flow, it's the old saw that says earnings are optional, but cash is cash. You once again see a very high correlation, and Facebook actually looks inexpensive based on operating cash flows from a historical point of view. But if you look at future growth expectations of operating cash flow, it's only going to be 14.5%, which was kind of announced in their most recent earnings report by their founder. And what you see here, that we had that 20% drop in value, but this stock could be rich based on operating cash flows. But if I look at EBITDA, once again, looking at Facebook, its price to EBITDA is very low and its forecast EBITDA is very, very high. And once again, if I go into the fund graphs and just look at Facebook's revenue growth, it went from 76 cents a share in 2009 to $14 a share of revenue by December 17th. So this is clearly a growth stock. Now next, let's look at the FANG stock Alphabet, or more commonly known as Google, now called Alphabet Inc. And once again, I want you to see the earnings and price correlation. Alphabet, like Facebook, has generated good profitability almost from day one. Their profits have grown at over 34%. But what you need to be concerned about, or at least cognizant about, is if I drop this to a 10-year graph, you can see that their earnings growth has only been 14% over the last several years and is forecast to grow at about 16 to 17% over the next 3 or 4 years. And even their long-term growth rate is only forecast to be about 18%, which would make this stock look very expensive at these levels. However, if I go to operating cash flow, as I've done with our previous two examples, you'll once again see that there's a very high correlation of Google to its operating cash flows over time here. And if I look at forecasting operating cash flows on this particular company, you can see that the analysts, and there are only 3 analysts forecasting operating cash flow, but they're expecting almost 22% growth, which would make it very inexpensive on a price to operating cash flow basis. And once again, if I looked at EBITDA, you would also see that on a price to EBITDA basis, the company looks very attractively valued. Earnings, not so much based on expected slowdown in earnings, but on these other metrics, which the market has been clearly valuing this stock, the correlation to price and EBITDA has been very high. It does look very expensive, but once again, you're dealing with a growth stock. Now, without going into the fund graphs, just looking at other metrics here. Actually, let's go into fund graphs and look at revenues. Actually, I apologize because Google just changed their symbol from Google.L to Google.L, and consequently, I don't have revenue showing up coming through Standard & Poor's yet. But again, this company has grown revenues at an extraordinary rate, just as they've grown earnings and cash flows, etc. And then finally, last but not least, let's take a look at Netflix, because clearly the valuation doesn't make any sense. Earnings have been, have grown nicely historically. Again, if I take out the forecast data and just look at historical earnings growth, it has grown at about 27% a year, but their PE is 159, almost 160 times earnings. And so the price is significantly above its earnings. Now, if I look at operating cash flow like I did with the other companies, this is very astounding. compounding on Netflix. The company has negative operating cash flow. Now, interestingly, and this is important, Barron's Magazine just today had an article on Netflix, and what the title of the article was, Why a New Disney Service Shouldn't Steal Subscribers from Netflix. And what they talk about in this article, and you guys can read it for yourselves, they're saying that Netflix is spending so much money producing unique content and purchasing content that if they spent less money on technology in 2017, their earnings would have been $1.48 instead of the $1.25. And then they also said that eventually its levels of spending on these secondary items they refer to it is going to not be necessary. When that happens, net income and free cash flow will turn substantially positive, because if I also look at Netflix from a standpoint of free cash flow, again, just like I saw with operating cash flow, it's negative free cash flow. That's because the company's spending so much money on content. However, now if I go into fund graphs and look at the company from a standpoint of revenues, or this is revenues per share, you can see they've gone from $1.80 or at the low 77 cents in '02 to $27.07 by 2017. So even though Netflix isn't bringing money to the bottom line because they're spending so much on content, this is still a phenomenal growth stock, and that phenomenal growth is explaining to a great extent why the price has gone up as much as it has over the years. Because if you look at the long-term track record, Netflix would have turned $10,000 into $873,000 had you bought it on December 31st, 2003 and held it till yesterday's close. But there have also been times when, the stock price has fallen rather dramatically in value. If I go back and look at some of these historical times, you can see in 2011 when the price got dramatically, highly valued, even the PE was only 73 then, and we saw this reversion to the mean, but then that was again followed by dramatic upside in the stock. So this is clearly a stock that the market has been valuing based more on growth. But the moral of the story that I've tried to really illustrate with these videos are that the Fang stocks are powerful growth stocks. And as such, even if you dramatically overpaid, had you bought Netflix on that day when it was trading at a 73 multiple, even though it corrected dramatically after that and held it through yesterday's close, you'd have still made a compounded rate of return of 36% a year. So buying these growth stocks is certainly not for the faint of heart, and the valuations may not make sense if you look at them looking at traditional measures. But if you look at these companies from the standpoint of how fast and how powerfully they're growing their business, they're not quite as mysterious as some people think they are. Now, I personally wouldn't invest in Netflix. I just can't buy a stock trading at 158 times earnings, and I can't buy a stock that's not generating any operating cash flow, and I can't buy a stock that's not generating any free cash flow. But if I do look at the company from the standpoint of EBITDA, it does look more attractive, assuming that the EBITDA actually does grow. But even here, I think the stock is overvalued based on expected EBITDA growth. But even so, you could still make, multiple, 20% annualized rates of return buying this stock, assuming they do generate the growth. Anyway, this has been Chuck Carnevale saying thanks for watching. I hope this gave you a little different perspective on these Fang stocks. If you find fast graphs interesting, you might want to give us a call at the number on the screen here, or email us at www.fastgraphs.com. Anyway, it's been my pleasure. I hope this gave you some different insights into powerful growth stocks and how to invest in them. Thanks for watching.